open the mail from the IRS. A lot of people get nervous if they see a letter from the IRS and they put it into a drawer and they forget about it. That's the worst thing you can do. Open your mail right away, read what it says. If you need help, call your CPA. Stay on top of things. Don't procrastinate.
Microphone check, 1, 2, what is this?
You're now listening to a brand new episode of the Play Big Faster podcast.
Look what you done started. Let's go.
Welcome to another episode of the Play Big Faster podcast. I'm your host, Cherie Prince, and we're joined in this episode by Gary Massey. Gary is a CPA, and one of the things that he loves to do is help entrepreneurs stay out of tax trouble. Gary, welcome to the podcast.
Thank you, Cherie. It's great to be here with you today.
So tell me, how long did you know that this was your calling and that you actually like to work with numbers and tax stuff? Because it's not the sexiest thing.
Well, that's a great question. It happened accidentally when I went to college. I was interested in liberal arts and other things, and I fell into this. But what became really exciting for me after many years of working for other large CPA firms is I realized that I could be an entrepreneur. And I use tax and accounting as the subject of my entrepreneurship. And I'm running a business just like all the other small business owners who are perhaps listening to this podcast. And that is indeed what makes it exciting.
So there are horror stories that you hear sometimes about small business owners and them not either timely paying their taxes or penalties and interest. What are some of the things that small business owners, if you're new to business, just some very basic things that they need to consider tax-wise before opening a business?
Well, that's a great question. One of the things that everybody has to know is that taxes are due to the IRS and to the state in which you live on a quarterly basis. Don't wait until the end of the year. If you do wait, what will happen is the IRS is going to impose interest and penalties, which you'll have to pay. They expect you to pay quarterly. So everybody needs to do that, and they need to meet with their CPA to go over how much they should pay on a quarterly basis. But that is one of the best ways of staying out of tax trouble.
What if someone can't afford to pay their taxes?
If they get to the end of the year and they can't afford to pay the tax bill, the most important thing is that they're upfront with the IRS, that they contact the IRS and they can do it through their CPA. If they're nervous to do it on an individual basis, they can work with a CPA and go to the IRS and say that you want to make a deal, that you want to be compliant, you want to follow the rules, you want to file tax returns, but you don't have the money right now. And the government is going to work with you. They're actually very cooperative if you show that you are cooperating with them and that you're following the rules. And one of the most important things is to file tax returns on time. So individual tax returns are due April 15th, and that includes many businesses as well. Some businesses are due March 15th. It depends on how the business has been structured. But file the returns on time, even if you can't afford to pay. It will save you from penalties, and it shows the government that you want to cooperate and work with them and follow the rules.
One thing that I think is really interesting that some business owners may not consider is that if you do make it to the end of the year and you cannot afford it, then that's one thing. But do you have any tips in terms of maybe the percentage per dollar that an entrepreneur may want to hold back in a reserve account to pay taxes? Because we don't want them to get to the end of the quarter or the end of the year. Is there like a magic number, like for every dollar you earn, that you can save for taxes?
Every situation is going to be different. There will be, of course, deductions. You don't pay tax just on your gross income, meaning what your sales are. You get to deduct all kinds of things. And that's an opportunity to save on taxes, to maximize tax deductions, which bring your net income down. But eventually, once you get to a net income number, that is going to be subject to taxes. Now, as I said before, if you pay it quarterly, you're not going to have this pressure at the end of the year of trying to come up with all of that money, because many people can't do that. But if you do ask the question, if there's some rough number that you can use, it's somewhere around 30%. It depends upon the level of income you're making, because there are different tax brackets. It depends on the state in which you live. And sometimes it depends on the city in which you live, because states and cities have their own taxes, and everyone is going to be different. But if you are looking to put money into reserve, Around 30% or so is a pretty good number to use.
Now, for those businesses who may have bitten off more than they can chew in terms of tax liability, there is something called an offer in compromise. How does that
Yes.
work, and when should someone talk to their CPA about an offer in compromise?
The offer in compromise is one of several different programs that the IRS has. And the purpose of these programs is to help people get in the good graces of the IRS. So the offer and compromise program, one of these programs, is a program that's talked about a lot. It's very popular. You hear about it on late night TV. And it's a perfectly legitimate program. What it means is that you work with the IRS to come up with a number that they feel that you could pay based on your earnings and your expenses. They take into consideration where you live, the expenses in your geography, what you need to pay for, say, for example, transportation and car and housing for your family, how many members are in your household, all of that. And the IRS comes up with a number that they feel that you're able to pay. And if that number is low enough, it could even be lower than what you owe in tax, then they will accept that lower number. And that's a great thing. And that's a great way to reduce the amount of tax. But in order to get that, in order to be able to participate in the program, you have to have filed all of your tax returns. You have to be in compliance, which means in particular that the last 6 years of returns have been filed. They're all on file with the IRS, and that you're paying your quarterly taxes too. If you don't pay quarterly taxes, then they're not going to cooperate with you. But for the people who are complying and who are really having a hard time paying because they don't have enough money or they don't have enough assets, the offer in compromise is a great program. And for people who are interested, they just have to contact their CPA or someone who's qualified in handling these kind of negotiations. There aren't that many CPA firms who can do it. It's a specialized area. But speak with someone who is qualified and knows about the offer in compromise program and see if it is going to work for you.
So, is there a limit on how often you can use this program? Is this something I can use every year to reduce my taxes?
You could do it every year, but I would say that at some point the IRS is going to be suspicious of what's going on. If you're earning money, why can't you pay taxes? And I would think at some point they're not going to really want to work with you. It's not a way to be making a business. Businesses are supposed to make money. You make a money, you're making money through your small business so you can support yourself and support your family. And it's okay to pay taxes. Everybody pays taxes. I pay taxes. We all do. It's just part of life. And it's part of our responsibilities of being citizens and residents of the United States. So that's okay. It's legitimate to pay as little as you can under the law. So one of my jobs is to do tax planning for our clients so they pay the least amount possible as long as it's legal.
And that was my very next question. And I was poking fun about doing it every year because the goal is that you don't need it until you actually need
Right,
it. With proper
right.
tax planning.
That's right.
Yeah, with proper tax planning, that's something that you should be able to forecast and make plans for. So, could you tell me the difference between someone who is merely a tax preparer and then someone like you who is a tax planner?
That's a good question, Cherie. So, tax planning is looking forward. Being a tax preparer is looking backward. If somebody gives me a stack of papers, their 1099s and W-2s and their receipts for charities and other kinds of things, and we just use that to prepare the return, that's looking backward. We can do that, but it's even better if you are looking forward. And looking forward means coming up with legitimate tax planning ideas, and there are a lot of them. And we help our clients a lot. And I will tell you, and this should be of interest to your audience, that the greatest tax planning opportunities are people who own businesses. If you're an employee at a company, it's harder to do tax planning. There's not as much you can do. There are things, but it's harder. But once you have a business, then all of a sudden you find that things which are normally, say, personal non-deductible expenses become deductible. For example, you can have a home office, which is deductible. You can have a car. That's it. That's exciting. Your automobile, all of a sudden, a portion of your automobile becomes a business expense. You can hire children. You can hire your own children to work in your business. And hiring the kids is a great way not only to reduce taxes, but it's a great way to teach your kids how to become entrepreneurs also. It's a great lesson to your kids if you get them involved in your business. It will save you taxes and it will give your kids a tremendous opportunity to learn about real life, about saving money, about being businesslike. And that's a wonderful gift that you can give to your kids.
A large portion of the people that I work with in my coaching program and at my law firm are real estate investors. Do you have any tips that would generally apply just to real estate investors, or even not so much generally, but would benefit real estate investors more?
Absolutely. So, real estate investing in real estate is a business too. There are tax deductions for business owners who have whatever kind of a small business that they're interested in doing. So too do real estate investors. And one of the techniques that I have found to be the most beneficial for our clients is what's called cost segregation. And cost segregation is an opportunity to use the depreciation rules to get a lot of benefits from your real estate. It's a complicated area, but it's very significant and it's helped a lot of our clients. It specifically relates to investors in some kind of rental real estate, commercial or rental real estate. The Airbnb is a particularly good way of doing it. If you have an Airbnb, all of a sudden, all kinds of limitations on tax deductions start to slip away, and you get to really benefit a lot from tax rules. So I would suggest that your listeners who are considering real estate write down cost segregation because that's a really great opportunity.
Are there different opportunities with commercial real estate that you don't normally see with residential real estate? Or does it matter in terms of how you depreciate the assets and the opportunities that are available?
In this case, it doesn't matter. If you qualify for the deductions, and there are limitations, there are special rules called passive activity loss rules, which we don't have to go into now. But if you qualify, if you overcome those rules, it doesn't really matter if it's a commercial property or a residential property. You can benefit from cost segregation either way. The Airbnb idea, which is, of course, residential, that's where people stay, that gets around some of the limitation rules. So that's really geared towards people who are having, but it's a pretty wide open area when it comes to real estate as far as tax savings.
Let's pivot a little bit. What about companies that deal with sales tax? Are there any special tips that you can share with us about sales tax?
That's a great question, too. Sales tax is very important for a number of reasons. First of all, if you, both with sales tax as well as payroll taxes, if you are not submitting those taxes to the government, you as an owner can be in really big trouble. You can be held personally liable for those taxes. It's not just the company, you, the owner, are going to be responsible. So that's one thing. Secondly, the states who are responsible for collecting sales taxes are very aggressive. They're more aggressive than the IRS, in my experience. And people need to be really diligent about their sales taxes. There's sales tax audits happen all the time. So typically what it means are different situations, but typically it means that you are shipping into a state. For example, let's say I'm in Georgia, for example. So if I have a business and I'm doing e-commerce and I'm shipping to clients in California, so the state of California is going to want to charge a sales tax on that. Now, it depends on all kinds of factors. It depends on how much you're shipping into the state. It depends on if you have any other inventory or if you have property in that state or any locations and so on. But you need to find out what are the thresholds for sales tax in those states, and every state is different. And in fact, every city could be different. For example, I live in Atlanta, and the sales tax rate in Atlanta depends on exactly which zip code you are located in. And it's very sensitive. You could just move over a little bit and you have a different sales tax rate. So you have to know what the thresholds are that are going to trigger sales tax, where your customers are located, and you have to know what the rates are. So it requires a certain amount of diligence to make sure that you're doing that right. And some of the greatest sensitivities are when people are doing e-commerce, when they're shipping out of state. If you have a so-called brick and mortar location, like if I'm in Atlanta and I have a clothing store, people come into my clothing store, it's pretty obvious what the sales tax rate is going to be. But it's when you're shipping out of state that it becomes a problem. So folks who are involved in e-commerce or any kind of shipping business like that need to understand what the rules are in the states where their customers are located.
So, Gary, I have been sitting here listening to all this great advice, and it has brought me to a question that I know a lot of our listeners would probably love to hear a lot more about. What happens if you get audited? What are some of the first things you can do if you're
Well,
audited, and maybe some things to do to prevent an audit?
so what's going to happen is you're going to get a letter from the government, and there will be a series of letters, and it's a series of letters that become more and more severe as time goes on. The most important thing, and I always say this, is that you have to open the mail from the IRS. A lot of people get nervous if they see a letter from the IRS and they put it into a drawer and they forget about it. That's the worst thing you can do. Open your mail right away, read what it says. If you need help, call your CPA and act on it. And it will be okay as long as you can, once again, as I said earlier, as long as you can show the government that you're cooperating, that you want to work with them, it will all be okay. Typically, what they're going to ask for is proof that the deductions on your return are legitimate business expenses. And the best way to show that is if you have the receipts. So business owners should be keeping their receipts. It's not enough to show a bank statement which shows money coming out because you don't know what the person bought. For example, if I go to Macy's to buy something, I could be buying a personal, say, clothing for my personal use, or I might be buying, I'm not sure what they sell at Macy's, or something like, say, furniture for the office. So furniture that you buy at Macy's for your office is a legitimate tax deduction, but your clothing is not. So it's not enough just to show a bank statement that you went to Macy's. You need the receipts to show it. And that's the most important thing. They can keep it on paper, or better yet, they can use a smartphone to take a picture of their receipts so there's not so much paper floating around. And if you do that, then you're pretty much audit proof. You're protected. The only thing I will add on to that to be audit proof is you also have to keep good bookkeeping and accounting records. I recommend QuickBooks Online for most of my clients. There are other types of software. Some people use Excel or spreadsheets, but you need to keep something, good accounting records that tie to your bank, that are reconciled on a regular basis, that you can show the auditor if they're ever going to ask, because they will ask for that. They'll ask for your accounting records and they will ask for your receipts. And if you have all that, you're pretty much audit proof. And that's how you protect yourself.
And if you had one piece of advice to share with an entrepreneur on just how to play big faster, what would it be?
As I said before, open the mail. Open the mail from the government. Stay on top of things. Don't procrastinate.
Gary, thank you so much for being with us. And everyone, until next time, play big faster. Thank you.
Thanks for listening to this episode, and remember to play big faster.